On July 4th, 2025, Congress passed new tax laws under what is now known as the One Big Beautiful Bill Act, or OBBBA. This sweeping legislation introduces significant updates across the tax code, impacting how Americans will file their taxes for years to come. I'm going to cover some of the main changes that you're going to see for tax year 2026. So first is the introduction of Trump child savings accounts, and these are going to be effective from 2026 to 2028. And it's a new type of savings account for children under the age of 18, and it was newly created as part of the bill. The contribution limit will be up to $5,000 per tax year, adjusted for inflation after 2027. Employers may also contribute up to $2,500 per year to an employee or a dependent of an employee. Contributions in the account are not tax deductible until the child turns 18. Trump savings account are tax deferred, meaning earnings on investments inside the account are not subject to tax until withdrawn. Children cannot make withdrawals until they reach age 18. Now, Trump accounts will automatically be funded for babies born between 2025 and 2028. The federal government will make a one-time $1,000 contribution per child to a Trump account for U.S. citizens born during this time. Now, the child must be a U.S. citizen to receive the funding. An account will automatically be created by the federal government if an account is not previously created by parents. The next change is child and dependent care credit expansion, and this is effective 2026 and beyond. The maximum percentage of expenses that you can claim for this credit has increased to 50%, but the threshold of expenses remains the same at 50% of $3,000 for one person or $6,000 for 2+ people. Additionally, the phase down ranges are much higher income levels or adjusted gross income than prior rules. For single taxpayers with an adjusted gross income between $0 and $15,000, the credit percentage is 50%. Between $15,000 and $45,000, the credit phases down from 50% to 35%. Between $45,000 and $75,000, the credit percentage is 35%. And between $75,000 and $105,000, the credit percentage phases down from 35% to 20%. And then over $105,000, the credit percentage is 20%. And for taxpayers married filing jointly with an adjusted gross income between $0 and $15,000, the credit percentage is 50%. Between $15,000 and $45,000, credit phases down from 50% to 35%. Between $45,000 through $150,000, the credit percentage is 35%. And between $150,000 and $210,000, the credit percentage phases down from 35% to 20%. And over $210,000, the credit percentage is down to 20%. Now, the next change is a premium tax credit change, and this is effective 2026 and beyond. And changes to premium tax credit rules and underlying marketplace eligibility and insurer options may decrease the number of individuals with health insurance coverage through the marketplace. So this is relating to health insurance premiums, and specific changes include expanded repayment scenarios. And this is going to start in 2026. The new law expands the situations where an individual may be required to repay the full amount of any excess advanced premium tax credit received during the year. Also, household income changes in eligibility, and it starts in 2026, and it eliminates eligibility for the premium tax credit for individuals who enroll in marketplace coverage during a special enrollment period due solely to a change in household income. There's also eligibility restrictions, decreases in eligibility for certain lawfully present individuals, and that starts in 2027, including those who have income below 100% of the federal poverty level starting in 2026. Also expanded documentation requirements starting in 2028, and this requires additional verification of specific insurance application information, including household income, immigration status, and family size. Next change is the American Opportunity Credit, Lifetime Learning Credit, and Student Loan Debt Cancellation requirements. And this is effective 2026 and beyond. You can claim the following education-related tax benefits provided the qualifying individual has a valid Social Security number for work. So here are the related tax benefits you can have. The student loan debt cancellation exclusion. So if student loan is discharged due to disability or death, you can exclude the amount from your gross income. The American Opportunity Credit, AOC, and Lifetime Learning Credit, LLC. For those with qualifying expenses, these credits allow students and families to reduce their taxable income. Additionally, for the AOC, you must now have the institution's employer identification number. The next change is employer contributions to student loans, and this is effective 2026 and beyond. And the rule allows that employers to help pay student loans. This rule has been made permanent, so employers can provide up to $5,250 for payment of principal and interest on an employee's qualified education loan. This allowable amount is going to be adjusted for inflation annually. The next change starting 2026 is the Qualified Residence Interest Deduction, and this is effective 2026 and beyond. So the previous limit set in 2017 on the mortgage interest deduction for home acquisition debt is now permanent. So the threshold will continue to be $750,000 or $375,000 for married filing separately. And with this, mortgage interest premiums, known as PMI, that are associated with the acquisition of debt may now also be treated as mortgage interest. So this is a big change. Interest on home equity loans remains excluded from the definition of qualified residence interest and therefore continues to be not deductible. Another change in 2026 is the charitable deduction expanded to non-itemizers. So this is starting 2026 and beyond. With this new law, taxpayers who claim the standard deduction, and this means that they don't itemize their deductions, they're going to be able to claim a charitable deduction for cash contributions. Now, this rule does not apply to property contributions that somebody might make to a charity. And the new deduction amounts are going to be capped at $1,000 for single and $2,000 for married filing jointly. The next change also relates to charitable deductions, and this is charitable deduction change for itemizers, and it's effective 2026 and beyond. If you claim an itemized deduction for charitable contribution, you will be required to reduce your deduction by 0.5% of something that's called your contribution base, which is generally your adjusted gross income. These were some of the main tax changes that you are going to see effective for 2026 as part of the passing of the One Big Beautiful Bill Act. However, there are many other changes that could impact your personal tax situation. Be sure to check out our video on the 2025 changes. And if you have any questions about how it might impact your taxes, talk with a qualified tax professional and they can help you with your personal tax situation. To stay up to date on the latest financial news and updates, follow us on YouTube and Instagram. And if you have any questions, please reach out to our office and we would be glad to hear from you. As a reminder, this video is provided for education purposes only, and it is not intended to provide advice specific to your situation.